Welcome to Redwood Capital Solutions, LLC. Starting a new business can be an exhilarating endeavor, but it often necessitates financial backing to get off the ground and grow sustainably. In this guide, we will explore various avenues available to entrepreneurs for funding their startups, offering insights into each option's advantages, challenges, and suitability based on different business stages and needs. 1. Bootstrapping, using personal resources. Bootstrapping involves funding your startup with personal savings, credit cards, or revenue generated from initial sales. This approach allows entrepreneurs to maintain full control over their business without external investors' influence. While it minimizes debt and external obligations, it requires individuals to risk their personal finances and can limit the scale of initial operations. Friends and family, early support networks. Seeking financial support from friends and family members is a common option for early-stage startups. This method offers quick access to capital without the formalities and stringent requirements of traditional financing. However, clear communication, transparent agreements, and managing personal relationships are crucial to prevent potential conflicts and misunderstandings. 3. Angel investors. Strategic funding with expertise. Angel investors are affluent individuals who provide capital in exchange for equity or convertible debt. Beyond financial support, they often bring valuable industry expertise, networks, and mentorship to startups. This funding option is well suited for businesses with high growth potential and innovative business models seeking strategic partnerships to accelerate their growth trajectory. 4. Venture capital, scaling with strategic investment. Venture capital, VC, firms invest significant amounts of capital in startups with high growth potential in exchange for equity. These firms typically focus on technology-driven ventures or innovative business concepts capable of achieving rapid scalability and market penetration. VC funding not only provides financial resources, but also strategic guidance and access to extensive networks that can propel startups to the next level. 5. Crowdfunding, engaging communities for support. Crowdfunding platforms enable entrepreneurs to raise funds from a large number of individuals who each contribute small amounts. This approach not only secures capital, but also validates market interest and engages early adopters as brand ambassadors. Crowdfunding campaigns can generate buzz, validate product concepts, and attract potential customers, making it an attractive option for startups looking to leverage community support and market validation. 6. Bank loans and SBA loans, structured financing options. Traditional bank loans and Small Business Administration, SBA, loans offer structured financing options for startups with solid business plans and collateral. These loans typically feature competitive interest rates and manageable repayment terms, making them suitable for businesses seeking to finance specific growth initiatives, purchase equipment, or expand operations. However, securing bank financing often requires a strong credit history, collateral, and a detailed business plan.